Good morning, LifeWealth family. This is Hilgardt here from the Captain's Chair. It's Wednesday, October 12th today, and a lot of things are happening in the markets and in the news. So I want to just touch base with you on three areas specifically. One, I want to give you a quick update of what's going on in the markets and in the news that is relevant and its influence in the markets. Two, I'd like to talk to you a little bit about what are we doing in response to it. And three, I want to give you an invitation. So what's going on today or this week? What's happening at the moment is that we're trying to look through economic indicators whether or not our inflation is coming down and if the heat of our economic engines is slowing down. And what normally is a good indicator, unemployment and the amount of open jobs, is right now being a negative indicator. And what I mean by that is that the Fed is trying to figure out, and the markets are trying to figure out what the Fed's going to do, and the Fed is trying to figure out how they can get inflation to slow. The target rate of inflation, which will come out, by the way, tomorrow, is at the moment at 8.3%. We want to see that rate come down, and due to the interest rates that have been rising so far the last month. So based upon how well unemployment numbers is, if inflation rates goes up, the unemployment rate should go up. Actually, more people should lose their jobs, and at the moment still the economic engine is roaring, and a lot of open jobs still available, as well as unemployment rates being very, very low. Another factor that's not helping right now is that OPEC is seeing that the price of oil is going down, and they are going to be reducing their production of new oil, which increases the price of oil and increases the price of gas at the pumps, which again drives inflation. So it appears that really what is centered at this point in time is what the Fed's going to be doing with interest rates. And the Fed are looking at these economic indicators to figure out how quickly they're going to increase interest rates. So tomorrow is going to be a big day in the sense, if the actual inflation rates is coming out tomorrow, if those rates are between 8.1 and 8.3%, we should not see too much of an impact. If it's above 8.3%, the market should react very, very negatively, as it's indicating that the current rise of interest rates is still not battling inflation. Remember, the Fed's targeted inflation rate is 2%. So when we look at the micro, at this point in time, it's a lot of discussion or thinking or simply just guessing how quick the Fed's going to raise interest rates. I think we all need to understand that the Fed is going to raise interest rates. It's just a function of how quick. And if we can settle with that idea, and we can settle with the fact that we have to battle inflation, and the only way to do that at this point in time is raising interest rates, let's just get over that conversation. And let's spin more into the second conversation, which is what are we doing and what can you do about what you're seeing is happening in your accounts in the markets at this point in time. So we all are experiencing pain, and I'm working right through this with you. My accounts are down as well. And we're seeing most of the equity indexes like the S&P 500 and the Dow, as well as the NASDAQ, being down anything from about 19-20% year to date to about 32% on the NASDAQ. These adjustments are here, and it's still very, very volatile. So the areas that we're looking at is to start looking again at equity positions that got downside protection. A lot of these positions are things that are called structured notes, or the concept of equity indexing. We also are transitioning more to dividend-paying stock positions. On the fixed income side, the sad part is a lot of our bond funds are down as well. They're typically down between 12 and 20% for the year. But the one thing that is up is interest payment in income, and we call that yield. It's purely the interest that a person is receiving when you buy a bond fund. And a lot of these bond positions are really, really good buys at this point in time. We have a yield portfolio that consists of 7 different bond funds that on averaging is yielding in the 7 to 8% range at this point in time. Interest rates that we haven't seen in a long, long time. That's benefiting us. Other tools that are starting to look really, really attractive at this point in time is simply 2-year Treasury notes. 2-year, 10-year Treasury notes, government-backed bonds are looking strong. So these are things that we can transition to or look at or discuss with. It has everything to do with your unique situation, your age, how far you're out from retiring, and how this volatility is impacting your sleep at night. So I want to invite you to reach out to us, give us a call. Let's have a discussion. You can reach Joella or Susan at 407-299-4129. Schedule a 50-minute conversation, and if this is affecting your sleep, and if this is affecting the way you feel, or you just want confirmation that your strategy is on the right track. We have been very, very proactive on our side to work with our clients that are in retirement or very close to retirement to transition their portfolios, and we have constantly in communication with you, like communications like this, as well as our ongoing review. So we're here with you, going through the pain together, and we're doing a lot about it. My other invitation is feel free to please share this video recording with your friends. A lot of advisors don't reach out proactively to their clients and don't have proactive solutions. This is a time when we earn our keep, if you would, and where we can really help family, friends, colleagues that have questions are relative to what's going on in my 401k and how are my accounts doing. So feel free to share this recording with them, and if they would like, they could reach out to us as well, and we can schedule a 50-minute conversation to see how we can be of help to them as well. So I look forward to being with you in about 2 weeks again. Please, I say again, tomorrow might be a volatile day, as well as Friday, but we all should expect that interest rates is going to go up. And we also should expect that it would be a tougher year next year than it has been so far this year in the economy and the way it feels. The Fed has to slow things down through raising interest rates to counter inflation. So we're going to be walking through these difficult times with you. Have a great rest of the Wednesday, and I look forward to being with you in 2 weeks.